Welcome to Factful Finance. Did you know that about 90% of professional investors say that diversification is one of the most important aspects of successful investing? But why is it so crucial? Let's explore that now. Before we dive in, a quick disclaimer. The content shared here is for educational purposes only. For personalized advice, be sure to consult a financial professional. Diversification is the strategy of spreading your investments across various asset classes to reduce risk. Imagine you're building a team for a big game. You wouldn't want to fill the team with only one type of player. You need diversity. Strong offense, steady defense, and maybe even a wild card. The same goes for your investments. Without diversification, you're putting all your eggs in one basket. If that basket falls, your entire portfolio could suffer. A well-diversified portfolio, on the other hand, can weather market fluctuations because not all investments will react the same way to economic changes. Here's an example. Let's say you invested all your money in a tech company. A sudden dip in the tech sector could cause your investment to plummet. But if you also had investments in bonds, real estate, and international stocks, those could provide a cushion when tech stocks underperform. Let's take a look at the numbers. Over the past 30 years, a diversified portfolio of 60% stocks and 40% bonds has outperformed the S&P 500, especially during market downturns. Diversification doesn't promise that you won't lose money. It just helps reduce the volatility in your portfolio, so you're not as vulnerable when markets turn sour. Now, how does this apply to you? Think about David and Michelle. David invested his savings entirely in one stock, and when that stock tanked during a market crash, he lost a significant portion of his wealth. Michelle, on the other hand, diversified her investments across various sectors, and while she did experience some losses, they were much smaller in comparison. Diversifying isn't just about adding more assets. It's about choosing different types of assets: stocks, bonds, real estate, international investments, and even alternative assets like precious metals. By mixing different types of investments, you ensure that if one asset class isn't performing well, others may balance it out. To get started, use tools like financial calculators to determine your risk tolerance and consider investment apps that help you create diversified portfolios. Apps like Betterment or Wealthfront offer automatic diversification strategies based on your risk profile. So, what's your next step? Take a look at your current investments and ask yourself, am I too concentrated in one area? If the answer is yes, consider spreading your risk by exploring different investment vehicles. Thank you for tuning in to Factful Finance. If you found this information helpful, don't forget to like, subscribe, and hit the bell so you never miss out on our expert financial insights. What's the first step you'll take towards diversifying your portfolio? Share it with us in the comments.